Hey everybody, welcome back to the channel. Hope you're doing fantastically well. So today I want to take a quick look at an indicator which I believe is the best trading indicator out there by far. Now the reason why I think it is the best, because it is the most simple. Now often in life we think that to have better it's got to be more complicated and have more features, but reality is the best things in life are always the most simplest. Think about it, what is better than butter on hot toast? Now this indicator is used primarily when people start to get into trading and people want to discard it straight away, they get something more complicated. But I think if you add this one to your charts, it'll make you more consistent and a better trader overall. So I'll talk through some of the points of why I believe this is a great indicator, but always put in the comments down below what you think is the best indicator for yourselves, and I'll have a look at that one and possibly do a comparison in the future. Now for me, the best indicator is the moving average. Now it's a bold claim, and I'll stick with me and I'll try and explain why. It is simple, it's easy to use, we can add it to our charts. What it tends to do is smooth out all of the noise we're seeing. It is a lag-based indicator, so therefore it works out based on the average price over a certain number of periods, whether it's 20, 50, 200 as an example. It then smooths out that line and shows us what can potentially be a trend. So by smoothing out all the price data, we can then see price starts to go up or down or even flat. And based on that, we can then make a decision very quickly if we want to get into a long or a short. So as an example, if the price is above the moving average, whatever you set, whether it's 20, 50 or 200, and the moving average is sloping upwards, then for me, that is a buy situation. And the reverse is the same. If the moving average is sloping down and price is below it, then you're looking for sell opportunities. Again, just by using that very simple calculation, we can filter out a whole raft and junk trades that we know we get into and we make simple mistakes. And if we look back at the chart, we'll probably see if we'd stuck to that one rule, we'd have not done half of the trades we would have done. We can even use it for support and resistance. We can see as price often goes up, it always pulls back to where the moving average is. It then bounces off there and goes up and comes back down. It's like an elastic band where price moves further away and then comes back to where the moving average is. And again, these things do repeat, and I'll show some chart examples in a few minutes time just to look at how basically price doesn't get too far away from the moving average and it comes back over and over again. And anything that's repeatable makes it much easier to trade. So again, we can use that for a support and resistance. We can then start putting our stop losses just below moving averages. Now a lot of people say, yes, you want to put it below market structure. Yes, I agree with that one. If you have a recent low, put it below a recent low. But obviously, as we start moving up, some people want to lock in some profits and just move that trading stop up. And again, moving average, perfect for it. Another big one for me is all of the institutions, the banks, the hedge funds, etc., all use moving average on their charts. And if they are using it, then why aren't we not using it? It's very easy to get caught up in a lot of the other trading philosophy where they say, okay, we can look at a chart and see market structure. We can see where institutions are all actually putting their market orders and their liquidity. This doesn't actually make a lot of sense because a lot of these guys are only looking at the daily charts and the higher time frames. And that's why when you look at Bloomberg, if anyone does that, a lot of people show on the charts the 200-day moving average, and when price is pulling back to it, bouncing off it, using that as an indicator whether to start buying or start closing out their positions. And if it's good enough for the banks, hedge funds, institutions, why is it not good enough for us as retail traders?
This just sits beautifully on this 200-day moving average and a retest of it on the S&P 500. How important is that line now, Gina?
It's pretty important for a couple of reasons, not just because it's a 200-day moving average or it's some magic level, but it's also the bottom of an up channel that has existed since early 2016. So the market entered a new bull phase in early 2016 after we had a pretty significant correction in late 2015, early 2016. We've been in that bull phase and we've tested that bull phase a few times with tests of the channel. We tested it in February, bounced off the channel low. Tested it again in March, bounced off the channel low. That low happens to be right around the 200-day moving average right now.
Chris, for the value guy, how important is the pink line?
Well, the funny thing is, we could call that pink line elephants and giraffes, and it would still matter because everyone's watching, Jonathan. So if we go below that significantly, it's a big deal on Wall Street, and then that'll trigger sell programs, and so we do watch.
So I'm going to quick look at TradingView and just apply a couple of moving averages and see some of the Forex prices over the past couple of days, whether we take a 5-minute, 15-minute, 1 hour, or whatever they are, we can see how the price interacts with the moving average and we can use that into our trading strategies. So in this screen here, we've got gold, which we can see on a 5-minute chart. All I've plotted here is the 20 and the 50 moving average. Now we can see over the past day or so, price has literally respected all of these moving averages, where it's moved higher above the 20, it's come back, bounced off the 50, gone all the way back up, bounced off the 20. And we can see again today, every time price gets further away from the actual price action of where we are going from the 20, it comes back down, bounces off, comes back down. So we can see if we're looking for buy entries, we're a very, very simple one here. All we're doing is when price comes back down to the 20, we can take a buy order, put a stop loss below the 50 and let it run. So here on the British pound on a 5-minute chart, we can see as of yesterday, we had a bit of a sell-off. So as an example, we had the faster moving average breaking down through the slow moving average. That's called a dead cross. And again, a signal for a trend reversal, price starting to come down. And we can see price did fall all the way down. And let's say as an example, we were doing a sell. So we could have done a sell and potentially got a 3-4 to 1 on a risk to rewards, which to me that's a pretty good way of actually showing how we get some simple movement on the indicators and they always come down. Again, if we take a look at a higher time frame, so a 1 hour chart, same thing, price comes down through the moving averages, price is below, we're looking for short entries. As of today, it's getting a little bit more tricky. So we're now seeing the price is a bit more indeterminate. We wouldn't be looking for trades on that one as an example. Let's go euro dollar. So for me at the moment, euro dollar is showing some signs of recovery. We've seen a bit of a bottom out, 1.0845. We're now seeing price recover. Price is starting to come above the 50 and the 20 moving average. If we now get a golden cross, which is the faster moving average moving above the slower, we start to see a trend reversal and price could then start to come all the way back up. Again, this is clear price movement on a very simple moving average strategy. So one final pair, this is British pound, Japanese yen. Again, this is on a 4-hour chart and we can see when the fast moving average broken above, we can now start to see prices above all the moving averages. We're looking for buys, price comes all the way up, comes back down to the 20, bounces off, back down to the 20, bounces up. So for me, that's a repeatable pattern. I'd be now looking to buy into this one as it's bouncing off the 20 moving average and take it a lot higher. So you can see from those examples that I've just pulled out from 3 random charts that price does actually follow the moving average pretty well. You can customize this, you can put in slightly faster moving averages, you can start looking at different time frames and really build that up. And if you want to go and read a really good book on statistics on this one, if you look at the Total Traders, that whole foundation was based on moving averages and when price breaks up through them. So there we have it, just a few examples on a few charts in live data, how price is reacting to moving averages. That's all you need on your charts. Essentially, you are looking for price to react to something that is there, that institutions are using, which other traders are using, and you can actually use that to your advantage and filter out all of the bad trades. We all make bad trades. I personally make a lot of them. And by using some of these very simple rules, we can start to filter them out, make much better profits and become much better traders. So I hope you enjoyed today's video and I'll catch you again soon. Cheers.